Okay, another thing that's on people's mind is the market, right? So remember, we've had a number of years where the stock market has gone generally up. Now, I don't know about you, but I think for most people, we feel so smart when the market is going up. If we're invested in the market, we just feel so smart. We're so smart that we don't really need help from quote, experts or financial advisors, because we're so good at it. A lot of times we beat them anyway when the market's going up. So that's a real happy deal. When the market starts to get really choppy, like it's been this fall, it's like it happens to everybody. It happens to me too. I've been playing this game an awful long time. When the market starts to go down, notice what happens on Wall Street. When the market is going down, all the people who think that the world's going to come out and come to an end immediately get on, Fox Business News or the Wall Street Journal or whatever you're reading or looking at, and they're telling you about, I'm not sure we're going to be able to come out of this, things aren't looking good. And so it's like a multiplier of gloom. And they have the other thing when the market's going up. When the market's going up, then all the rosy predictions make you feel like, man, I better get in on this before the party's over. When it's going down, it's like, oh my goodness, I'm not sure what to do. And then the problem that we have, well, a couple of problems. One problem is that for a lot of people, the joy of markets rising is less than the pain when markets decline. It's like, in life, we don't have as much fun when it's going up as we have pain when it goes down. It's like it's asymmetrical. So that's another problem. Now, another problem with this is that when the market starts to go down, we question what we've done, even though we were real happy with it until last summer, let's say. So just for example, not to pick on anybody or anything in particular, Apple stock has been a long time winner in the market, right? And I think it was last summer, there were all these headlines saying Apple was the largest company in the world by market capitalization. Market capitalization means if you take all the stock out and multiply it by its value, and it was $1 trillion company. Which is it's kind of remarkable if you think about Exxon owns so much stuff everywhere, right? And it really is a big company. And Apple, which in terms of number of people working there and all those kinds of metrics, stuff they own, actually own, their stock was more than Exxon stock at that point. Just for example. Anyway, so a lot of people felt mighty good about that. But if I'm not mistaken, Apple has gone down like 30% since last summer. It's no longer the $1 trillion company. And so then, let's say, I know one of my clients had a big stake in Apple, and he's been proud of that thing for years, and he would always tell me about it and how good it was, and how fast it was rising, and how much money he made. And I haven't talked to him about that in the last little bit, but I imagine that after going down 30%, it raises a lot of questions. And the questions go like this: should I have sold already? Right? Should I have sold? Did I miss the point where I should have gotten out, or I should have lightened up on the Apple stock? So that's the kind of question we ask ourselves. We ask ourselves, well, I wonder if the whole landscape has changed with Apple. They rode the iPhone so far. Are they now going to be eclipsed because something else is going to be the big new thing, and Apple hasn't come out with the new product lately? And so it raises all those kinds of questions about our portfolio. So this time when it's choppy is a good time to take a look at our own situation and decide whether we have confidence in what we're doing and whether there's a need to make adjustments. Now, the market has generally been up since the Trump election, but it's been taking quite a slide here lately. This is from last spring, and just because this chart was kind of dramatic, this kind of stuff makes people anxious when the trend seems to be down, to put it mildly. Now, stock market corrections are going to happen as retirees or as investors. What we want to have is a certain amount of peace of mind about what we're doing with our investments. So a lot of times these times when the markets are choppy is a good time to assess where we are, where we're going, and what we're comfortable with. The other aspect of this is that for husband and wife, a lot of times the husband and wife are not really on the same sheet of music with their investments. In other words, maybe one of them isn't very much involved to start with and might be pretty conservative about things, and the other one's involved and not so conservative. If something happens to the one that's managing it, it creates all kinds of anxiety for the surviving spouse in that situation. So if the family is going to avoid taking a big hit when one spouse passes away or the market crashes, it's a time to make sure everybody's on the same sheet of music. So it may be a good time to analyze what you're doing, where you're going, and how it's all in. Now, as you probably know, or maybe not, risk and return depend on what you own. So let's say that's too obvious, but a lot of people, a lot of advertisements and a lot of financial talk seems to not believe that. So I hear ads and I read material from other investment advisors where they talk like that they're going to give you the winners but keep you from losing. Okay, in other words, they're going to manage things so that you're in the winners but you don't take the losses. Another way that this gets expressed is people will say that if you're a really smart investor, you don't want to have the down risk. You just want to have the growth, the upside. This is virtual. A person that accomplishes this was lucky. Okay. The simple fact is that the research, I'm talking about Nobel Prize winning research, I'm talking about the research and studies that have been done, they all say that this is not really easy. It doesn't work. If somebody pulls it off, they were lucky. So really the nature of the game, an asset that is safe will have a lower return. An asset that is volatile will have a higher return. Okay? And so in a way this makes sense. If you're investing in CDs, well, you're not taking much risk and the bank can't take much risk, and so the returns are lower. If you're invested in stocks, the returns are higher because the risk is higher. So these things are related, and they can't really be uncoupled. You have to, if you say, I want safe stuff, you're not going to get the same return that you would get with a portfolio that's more growth-oriented, for example. It's just that simple. There is no free lunch here. So kind of understanding that. The other thing that you want to understand as an investor is how much punishment can I take before I decide I have to sell out. Because a lot of times the damage that was done in 2008 and the damage that was done in 2002 that I saw was because people had portfolios and they held on until all the news was bad, and then they gave up and sold out. And in some cases they just went straight to CDs or they bought annuities where they sat out. And in that case they took the loss. And a lot of those people in 2008 never recovered from it, never got back into the market. So they took a permanent loss at that point. Now this is just human nature to do that. So how do you beat it? You've got to know or believe that the stuff you hold, if it goes down, will go back up. And you also have got to, come to grips in your own mind with how much decline in value can I stand before I'm going to bail. We don't want to be there, okay? Because the game is to hold the stuff, the good stuff, and that's how you win long-term as an investor. But these choppy markets make us crazy, and down markets make us do dumb things. And where the family isn't on the common sheet of music and one spouse dies, that's another big chance to take a huge loss. So when things are going along and it's fairly flat and up, everybody's happy, it's easy to manage. The problem comes when one spouse passes away and there's not a clear plan, or when the markets are chopping it down. That's when there's a tendency to make a lot of mistakes. Well, you make a mistake when the markets are all high too, like the tech bubble. But there's a lot of places to make a mistake. But it's not when it's typically not when the market is up for a long period of time. So the point is that there's a lot of people that are sort of complacent about where we've been. So it may be a good time to take another look.